But I think that now is not only a bad time to get into housing, to buy your first home, it's probably the worst time, unless you are an all cash buyer. In that case, your circumstances are different.
Welcome back to House Rich, the first time home buyer show where we help millennials figure out how in the world do I buy my first home. That is a clip from CFA Larry Cheung from a video entitled Housing Market Predictions. The 2023 housing crash has just begun. This is my first reaction video. When you guys sent this to me, and I was like, I usually don't watch these videos because none of the data that I can see supports any sort of housing crash. But I was like, it's got almost 500,000 spins. Maybe there's some information I'm missing because I'm always seeking information. I want to learn a little bit more. And spoiler alert, I disagree with maybe like 90% of the video, but he does have some charts and data that back up his point of view. And it's a different point of view. Like, hey, maybe I'm wrong. I am a realtor. As folks say, hey, maybe I'm just blind to the real estate market because I'm a realtor and I want everybody to buy homes so I can get money and be rich. Who knows? But I'm gonna look at his data and I'm gonna bring some data to counteract some of his points and to agree with some of his points. And let me know what you think. It's my first reaction video because you guys and gals asked for it. So let's get into it.
If you're new to my channel, make sure to subscribe, turn on the bell, and join me on Substack below for more, where I talk about US and China investment strategy.
All right, now, let's get into it.
Let's recap the consumer and big picture macro. We can see here that home prices have actually risen this year despite the high inflation and hawkish Fed rhetoric that we've seen throughout the year.
So I think that's a very good point that despite all the negative housing news, the housing market has risen this year. But also another data point is the housing market has done that every single year except for one since 2012, which is basically right after the global financial crisis, which was actually caused by reckless lending habits. So the only year that home prices did not increase year over year was from 2018 to 2019. And what was that great decline? It was from $326,400, the median home price, to $321,500 median home price. So basically less than a 2% decline. So no matter what data or information like the housing market bears throughout here, the home prices just go up. And why is that? Because people will always need a place to live. But let's keep going.
And we're seeing the U.S. Consumer Confidence Index jump to the highest level since early 2022. And because of this, many regions in the U.S., home prices are actually ticking higher. Now, in my opinion, the biggest bubble is actually not in stocks. The biggest bubble that I see right now is in housing. Why do I believe that? That's because the income to house price ratio is essentially at multi-decade lows, and affordability is extremely difficult for a lot of millennials and Gen Z, which makes...
So I think that's a very good point that he made, is basically the amount of debt consumers have versus basically the price of homes. And he's going to get into it a little bit, but I think one thing that's often overlooked when folks look at home prices going up, home prices going down, the bottom of the market, it rarely changes. The bottom of the market, always goes up, no matter what you see happening at the top of the market. Because think about it, like the top of the market, you have $1 million homes, $800,000 homes. So you may see like an $800,000 home slash from $850,000 to $800,000. Meanwhile, at the bottom of the market, you're not seeing a $250,000 home go from $250,000 to $200,000. That doesn't happen at the bottom of the market. And so wages are not increasing at the pace that home prices increase. So therefore, at the bottom of the market, there's always competition. And I can give you my real life experience from here in the Dallas market, looking for somebody to buy a home below $300,000. I've seen put offers on homes that have had 36 offers, that have had 19 offers, that have had 6 offers. One is at 14 offers. There's competition now, and there'll always be competition at the very bottom of the housing market because wages are not going up the same pace that home prices are.
Makes me believe that the only people that can really participate in real estate right now are investors or very well-heeled individuals. So people think...
one thing, I think that's kind of a misconception that somehow you need to be, daddy Warbucks to buy a home. I deal with folks that aren't rich, that make less than 6 figures. They're buying homes. I think that's a common misperception. And let's say that was true. Well, Okay, well, they're still buying the homes, right? So, eh.
I think that the housing market is strong, but I personally think it's not strong at all. It's illiquid. That's what's keeping prices high. I've got a lot of data to share with you today. Let's take a look at this chart here. It's the supply of housing inventory. We can see that it's tighter than ever. In fact, the number of homes for sale drops now to the lowest level on record. This is artificially keeping prices high. It's not.
And so I agree is the supply or the lack of supply is what is keeping the housing market from going down to the tubes, right? Because rates are so high, the reason home price haven't dropped is because there's scarcity with supply. But the other part of this other side of this coin is what in the world is going to cause the supply to increase? I read an article last week that we're 3.8 million houses short in the housing market. Where in the world are those houses coming from, right? So 3.8 million homes short, and there's not really a plan or a way for us to catch up. So, but yes, we're at historic lows right now, but there's no data that says we're going to get a flood of inventory onto the housing market. So folks may be thinking, well, when rates go down, people that are in this lock-in effect, they're going to put their homes on the market, which that is true, but they're also going to be looking for homes as well. So it's like one home goes in the market and then one home buyer comes on the market as well. So even rates going down and they're creating more liquidity in the market or more homes in the market, that really won't do anything to home prices.
Because there's a lot of demand. It's because the supply is extremely tight.
True story.
And because the mortgage rates now are north of 7%, and depending on your credit score, could get close to 8% for the 30-year, the market is actually becoming.
And depending on your credit score, it could be closer to the high sixes or sevens, right? That goes both ways.
More and more illiquid, where there are fewer sellers on the market and fewer buyers at certain price ranges for residential.
Yeah.
Now, if we take a look at this table here, this was back in May 2023, just a quarter ago, we can see that new listings, they're actually falling at a very rapid pace. And this is the metric that we should follow because this is constraining the prices from falling further to make it more affordable.
Agree.
Now, there is an optimistic and contrarian view about why the real estate sector continues to stay supported despite all the data that says that it should go lower. This is because
there's, I mean, honestly, there's no data that says the housing market should go down. Like I don't know what the data point is that says that, but I guess we'll keep
some
going.
economists think that when rates fall even slightly, there could be a surge in buyers to make inventory even more limited. If we take a look at this chart, nearly half of home offers faced bidding wars just a quarter ago. That's pretty significant.
Just what I talked about.
The economy in the US is softening. And because of these robust cash offers, it continues to be one of the biggest barriers to affordable housing. We can see here that 1/3 of US home purchases were actually made in cash about a quarter ago, earlier this year. And because of this, housing prices are actually ticking higher and rebounding from the decline that we've seen so far. And this could reignite.
And so, let's note that because the same people that have cash when rates are at 4 and 5%, way back in the day, they're the same people that have cash right now. So of course, like the percentage of people that are paying cash for homes is going to be higher when rates are higher because there are less people naturally buying homes.
Inflation concerns later this year and in 2024. Now, if we dissect the housing market, the best performing part in housing is the modestly priced residential areas. So the lower priced homes across the US, those are the areas that continue to be resilient.
And yeah, so that's kind of what I talked about as far as wages. And another thing I think a lot of folks don't realize when we talk about the bottom of the market is naturally going to be the homes that are a little bit beaten down and trodden, right? And so when you're buying a home with a loan, a lot of times you can't buy these homes that are in the $50,000 homes or the $100,000 homes because they're $50K, they're $100K because they're messed up. There's foundation issues, there are roofing issues, there's plumbing issues. Roofing and foundation being like the major deal breakers when it comes to financing, getting a loan. So yeah, they're the area or the domain of the cash buyer or somebody using like an FHA 203K loan, but a lot of folks don't even know what that is. So it's really just the domain of the cash buyer at the bottom of the market as well, the very bottom of the market.
All other price ranges many other price tiers within housing, especially if it's north of 500,000, those homes are having much more difficulty selling depending on the neighborhood. You can see from this map that neighborhoods like Rochester, Hartford, Portland, Worcester, Allentown, these neighborhoods within the states on this map, these are the neighborhoods that continue to sell well because those homes are selling at modest prices. Now, with the 30-year mortgage rate now rising above 7%, and depending on your credit score, reaching 8%, I believe that this market is becoming more and more illiquid. So be careful if you are a first homeowner and be a smart consumer. We can see here that Elon Musk talked about commercial real estate melting down fast and that home values.
Elon Musk need to worry about Twitter or X.
Continue, I want to give a shout out to Y-Charts, the data provider for my channel and my community.
So I'm going to skip through the ad, but Y-Charts is definitely a very good source of information. That's where I get a lot of my charts from as well. I'm a realtor in Dallas and would love to help you reach your goals of home ownership. So click the link in the description and just schedule a call no matter where you are on your journey. Not in Dallas? No worries, I can help connect you with a vetted realtor in your local jurisdiction as well. And feel free to share with friends, family, and foes. Everyone gets love.
Now let's talk about real estate investors. And I want to show you some data and helpful psychology behind a major force driving housing values in residential. This is going to be eye-opening. Look at this chart here. Investors, they own 1 out of 10 homes for sale. That is substantial because that means investors have a very big impact on housing prices going forward.
Yeah, so if you guys remember the article, the episode I did maybe a few months back about JP Morgan Chase buying $1 billion in residential real estate along the Sunbelt. Yeah, so big, huge institutional investors are hopping into the housing market. So in Texas, let's say back in 2012, like 1/3 of the homes were actually purchased by institutional investors. Not even talking about like your mom and pop investor. They may own like 1 or 2 homes. Talking about like the big boys buying up entire neighborhoods. And the thing is, like when a Chase buys up an entire neighborhood, that can actually shift the market. That like can set the comps, because if they buy 200 homes all in one area for $300,000, now every single comparable home in that area is worth $300,000, even though the homes previously may have been worth 200 or 250 or something like that. And sometimes we've seen builders experience issues with moving homes. They're not going to give those homes to you and me. They're going to give the whole package deal. They give them wholesale to the Blackstones, to the JP Morgan Chases of the world.
We can see that investor market share in terms of the percentage of total home sales in which an investor was the buyer was 18% in the first quarter of 2023. And we can also see that investor activity has tapered down significantly this year from prior years. This is important to realize because if this activity continues to decelerate, there is a very good chance that housing prices.
Yeah, because investors are just in the market for money, right? So if the deal doesn't make sense, naturally, like less investors will be in the market. So there's obviously investors that buy money with loans, hard money, or traditional loans. And so, yeah, if the numbers don't make sense, they're not going to be buying homes. So naturally, like the investor stuff will decrease. And jumping back to the previous chart, when we look at like the percentage of investors, that's not actually saying that more investors have started to invest. It's just saying a percentage, because once again, there are less people buying homes. Well, traditionally, like your residential buyer, because the prices are very high and folks are waiting on the sideline for rates to go down, as if like when rates go down, everyone's not going to jump off the sideline and create demand and a spike in home prices. But that's another episode.
Prices will fall later this year and in 2024, especially once supply ticks up. We can see investor.
But yeah, once again, like where's the supply coming from? Like there's no indication or any signs that supply will increase.
Purchases are really starting to tick down in 2023, and investors are also forced to target.
So let's jump back real quick. So that chart is essentially back to slightly where we're at 2020. We're just above 2020 level. So we're just kind of going back to norm. So things are just kind of evening back out. But one thing you kind of notice with this chart is it just if you notice with the chart, there's always this dip into the 2008 timeframe, but Yeah, we're just going back to normal levels, pre-COVID levels. Nothing to fret about.
To target affordable properties, not properties across the entire price range. They're really focusing on the affordable properties.
Yeah, so once again, if you're at the bottom of the housing market, you're going to be in trouble. So once again, I say right now, and I'm not saying rent out and buy a home, but now it is to buy a property in kind of a depressed market where there's less competition because the bottom of the housing market is not getting any better.
Now, here's an important signal to watch, and this is key. Watch for investors and their activity to stop buying residential. A lot of realtors are saying that once investors pull back from the residential market, it's likely that there's going to be a lot less bidding wars and sellers will have a much harder time trying to sell their houses above their list price.
I'm a realtor. I mean, I've not heard a realtor say that personally in my brokerage here in the Dallas Fort Worth. So, but if you're a realtor and you think that, drop a comment or email me.
Now, we can also see from the data that low price homes make up nearly one half of investor purchases. And 2 in 5 homes bought by investors are starter homes. This is actually rising to a multi-decade high. This is why housing feels so unaffordable, because even in the affordable sections of the market, we're seeing investors come in and swoop in and use all cash offers to buy those homes.
Once again, like, here's the thing, like, I don't disagree with any of this, but why would they stop doing this?
But it hasn't been an easy ride for investors across the board. We can see here that investors are most likely to sell at losses in cyclical areas, areas that have risen substantially since the pandemic because of their low inventory supply. Areas.
So, that once again, they just wouldn't sell the property. Right now, they're saying that they wouldn't sell the property. And a lot of this, well, I would say I don't have the data to back this up, but this is my assumption or my opinion right here is that there's a good segment of these investors that are just kind of fly by night. I call like pandemic gurus, where it's like, hey, home prices are going up. I can buy a home, do a crappy job, and then just sell it at 10, 15, 20, 30% profit because the market is so on fire. So a lot of the amateurs are getting burned in the market, whether it's flippers, your Airbnb folks, or whatever. So now it's time to separate the platinum from the white gold right now, is what is happening. And also this, I don't know, it's kind of like cherry pick data. I mean, I could throw up a stat that says home prices in like Tampa and Miami are up like 50% pre-pandemic. And actually, I'll throw up that chart for you guys to check out what's going on across the country.
Like Phoenix and Las Vegas, these are areas that investors are actually losing substantial amounts of money in. And if investors have to cut losses in those regions, there's a good chance that they may pull back in other regions as well.
And so one more thing, like, so like I said, that was a little bit cherry picked in my opinion, but like, if you're in Boston, if you're in Seattle, like, what do you care about what's going on in these other markets, right? Really, what matters is your local market. So make sure you're focusing on your local market, not necessarily national data. Local is what matters.
Liquidity dries up. Now we can see here that in Phoenix, investors lost money on 30% of homes they sold in March. And this may continue to go higher as mortgage rates stay stubbornly high above 7%.
Phoenix.
Now let's talk about renting versus owning
Let's
a home.
talk about
a lot of us want to own a home and we're constantly debating whether we should rent or whether we should own. So we can see here from this chart that in most cities in the US, it is now far more affordable to rent. There is a huge premium to pay the mortgage versus the rent, especially after you account for property taxes, maintenance costs, and operating repairs.
So very true, right? This is data. Once again, I'm not arguing with the data. And so if you're listening on the podcast, basically it's a chart and 85% of it says it's more affordable to rent than to own. But once again, this is assuming you buy a home today versus renting today. Imagine the mythical scenario where you somehow bought a home 3-5 years ago. What this chart will look like. It'd be completely different if you compared the price to, or if you compared the mortgage payment to somebody that bought a home in what's 5 years ago was 2018 versus today. And that's like the comparison or the math you need to be doing, because when you buy a home, yeah, the first year it's going to be cheaper to rent than it is to own. You're making a large capital investment in the property, but over time it almost always makes sense to purchase instead of renting. So this chart is not wrong, but it's just like it's a bad comparison. You want to look at what your scenario would potentially be 3 to 5 years from now. Because as I always say, you shouldn't buy a home unless you can plan to own it, not necessarily live in it, but own it for like 3 to 5 years, preferably 5 years.
There are also some secondary signals that we should watch for in the real estate market. And this is the investor activity for Airbnb and VRBO. Allow me to explain. We can see here that there are private equity and public funds, such as Invitation Homes, that actually go out, buy homes, rent them out, and they are buying those homes for tourists only. Essentially, they're using it for Airbnb and VRBO type of activity. Why does this matter?
So let him finish.
Because these homes are now pulled out of the supply, the inventory. They're not available for people to live in, and it's only available for tourists. And because of this, the supply of the inventory actually goes down, and that drives housing prices in that neighborhood to go higher.
So does it though, right? Because I think the impact of the Airbnb, the short-term rentals, is very much overestimated. So like here in Dallas, they recently banned Airbnbs, and folks are like, oh, that's going to help with affordability. Will it really? Because less than like 1% of the homes here in Dallas, and I'm sure it's like similar in most markets, are short-term rentals. And so 100% of the people that own short-term rentals are not going to sell the short-term rentals due to this housing ban or this Airbnb ban. Some are going to turn them into mid-term rentals. Some will turn them into long-term rentals. Some are just going to keep doing illegal stuff. And then some people will sell homes. So it will be a plus, but it's not going to be this earth-shattering change in the market.
We can see how important investor activity was based on the data I showed you earlier in this video. Now, if these investors start dumping these Airbnb and VRBO properties, what's going to happen is that the supply of homes in these neighborhoods will then rise, and therefore
not significantly
cause pressure for home prices in that region.
No.
So this is another signal that we can watch for the impending correction that I'm expecting in the real estate sector later this year and in 2024. We can also see that the activity for house flipping is also rapidly slowing down. And because home flippers aren't reaping the gains they used to, they're forced to sell homes at losses after deducting for operating costs.
So once again, these are obviously happening to some people that are good at their job, but let's not forget, the amateurs. You all see it online, whether it's Airbnb, the Turo gurus, all these people with no skills, no business acumen at all that happen to the market. So some of these are the people that are getting burned. And I guess Phoenix is taking just hell in general. Sorry, Phoenix.
And property taxes. These housing speculators, they're on the hook for operating expenses. And if they can't offload them fast enough, this could create problems for real estate investors going forward. Now, here's my opinion. And of course, this is not financial advice, but I think that now is not only a bad time to get into housing, to buy your first home, it's probably the worst time, unless you are an all cash buyer. In that case, your circumstances are different.
So I'm going to let him give his explanation. But once again, let's look back at the information that shows the median home price since 2012. I'm sure somebody has said some version of this every single year since 2012, and they've been wrong every single year. And so I'll just leave it at that.
Because once the unemployment rate goes higher, the housing market.
Why would it go higher though? Like the unemployment rate is going down. Why would it go higher?
Will transform from an illiquid to a potentially declining asset class as supply of homes goes higher and the ability of people to enter the market actually declines with joblessness increasing. So it's time to get cautious in housing, and it's definitely not an area that I think is promising over the next 6 to 9 months.
And so that's really the end of the video. But as I mentioned, like 6 to 9 months, 6 to 12 months, like if you're looking at that time frame to buy a home, like it makes no sense if you're wrapped up in this 2020 2021 idea where you see folks post online, hey, I bought a home in January, I sold it in October, I made $90,000. That's just a fantasy market, right? So 3 to 5 years is what you should be looking at. None of the data that I see says that inflation, not inflation, but inflation is going down, but that unemployment rate should shoot up. Like I'm not sure where exactly that is coming from, but yeah, unemployment is one of the big drivers in the housing market because yeah, folks can't don't have jobs, they're not going to buy a home. When folks are stable financially, they're more likely to buy a home no matter what's going on with interest rates, as we have seen today. So yeah, I think that was a good video by Larry. Like I said, I disagree with a lot of his points, but it's a different perspective, right? I just like to bring you guys different perspective. If you'd like to see more of these reaction videos, let me know. Tag me in videos and I will react to the best of my ability. And as always, buy land. Rumor has it they're not making any more of it.